If the United States lost a war tomorrow, could the dollar collapse? For nearly a century, the United States has fought wars across the globe: Korea, Vietnam, Iraq, Afghanistan. Some were victories, some were not. Yet something strange happened after each one. America could lose a war, but the dollar never lost power. In fact, in many cases, the dollar grew even stronger. So here's the paradox. If military defeat weakens empires, why has the currency of the United States remained the backbone of global finance? Why does the world still hold dollars, buy American debt, and settle trade in a currency issued by a country that has not always won its wars? This raises a deeper question. What actually supports the dollar? If the United States lost a war, what would actually collapse? The American military, the American economy, or something far more fragile? Trust. This is Hidden Pages, where money, power, and history collide, and nothing is ever as simple as it looks. Because the dollar is not just a currency, it is the central pillar of the modern financial system. But to understand whether a lost war could threaten it, we first need to understand what made the dollar powerful in the first place. After the Second World War, the global economy needed a new foundation. Europe was devastated. Asia was rebuilding. Gold reserves had been scattered by years of conflict. In 1944, delegates from 44 nations gathered in New Hampshire to design a new monetary system. The result was the Bretton Woods Conference. Under this system, the dollar became the center of the world economy. Currencies would be linked to the dollar, and the dollar itself would be linked to gold, $35 for 1 ounce. This arrangement effectively made the United States the banker of the world. Countries accumulated dollars through trade. Those dollars could be exchanged for gold held in American vaults. For a time, the system worked, but it carried a hidden contradiction. The world needed dollars to trade, but the only way to supply those dollars was for the United States to spend them abroad. Over time, that meant rising deficits, growing debt, and increasing pressure on the gold reserves backing the currency. By the late 1960s, the strain became impossible to ignore. Foreign governments began demanding gold for their dollars. America's gold reserves began to drain, and in 1971, the system broke. President Richard Nixon announced that the United States would suspend the convertibility of dollars into gold. The gold standard ended overnight. For the first time in modern history, the world's reserve currency was backed by nothing physical. No gold, no silver, no tangible anchor, only belief. But belief alone cannot sustain a global monetary system. Something else was needed to maintain demand for dollars. The solution emerged quietly during the 1970s, a new agreement between the United States and Saudi Arabia. In exchange for military protection and security guarantees, Saudi Arabia agreed to price its oil exclusively in US dollars. Soon, other members of OPEC followed. This arrangement created what became known as the petrodollar system, and with it, the dollar gained a new foundation: oil. Every country that needed energy now needed dollars. Japan needed dollars to fuel its factories. Germany needed dollars to power its industry. China needed dollars to sustain its manufacturing boom. The dollar became the bloodstream of global trade, a machine the world couldn't run without. And sometimes it grows stronger when America looks weaker. But this system created a powerful feedback loop. The United States could run deficits. Those dollars flowed abroad. Foreign governments reinvested them in U.S. Treasury bonds. And those bonds financed more American spending. It was a circular machine. Dollars left the United States, then returned as loans, and the cycle repeated endlessly. For decades, this system appeared unbreakable. But history teaches a simple lesson. Currencies are not permanent. They are political structures. And political structures can fail. The British pound once dominated global finance. At the height of the British Empire, nearly half of global trade was conducted in sterling. London was the center of global banking. British government bonds were considered the safest asset on earth. But the pound did not collapse because Britain lost one battle. It weakened after a series of costly wars that drained the empire's finances. The First World War left Britain deeply indebted. The Second World War finished the job. By 1945, Britain had exhausted its gold reserves and accumulated massive debts to the United States. The pound survived. But its global dominance did not. That role passed to the dollar. So the question returns, could the same thing happen to the United States? Could a military defeat trigger the decline of the dollar? At first glance, the answer seems obvious. If the United States lost a major war, confidence in its leadership might weaken. Allies could begin questioning American security guarantees. Markets might fear instability, but history suggests the relationship between war and currency power is not so simple. Consider the Vietnam War. The United States did not win that war. The conflict ended in withdrawal. And yet, during the following decades, the dollar strengthened its role in global finance. Or look at the wars in Iraq and Afghanistan. Trillions of dollars spent, limited strategic success. Yet investors continued buying U.S. Treasury bonds. Why? Because the dollar's power does not depend solely on military victories. It depends on the structure of the global financial system. And that system is deeply intertwined with American institutions. Global trade is largely settled in dollars. International loans are denominated in dollars. Banks hold dollar reserves. Central banks accumulate U.S. Treasury bonds as safe assets. In many ways, the dollar functions less like a national currency and more like global infrastructure. Replacing it would require rebuilding that infrastructure from scratch. That is not easy, but that does not mean the system is indestructible. Because the real foundation of the dollar is not oil or military power or even economic size. It is confidence. Confidence that the United States will honor its debts. Confidence that its financial markets remain stable. Confidence that Treasury bonds remain the safest asset in the world. And confidence is a candle in the wind, one gust, and it's gone. We have seen this before. In 1997, during the Asian financial crisis, investors lost confidence in several emerging economies almost overnight. Currencies collapsed, capital fled. Governments were forced to seek assistance from the International Monetary Fund. Confidence vanished. And when confidence vanishes, numbers on a balance sheet stop mattering. But the United States occupies a different position. It issues the world's reserve currency. That gives it a unique advantage. When global uncertainty rises, investors often buy more dollars, not fewer. During financial crises, capital tends to flow toward U.S. Treasury bonds. The dollar becomes a safe harbor in global storms, which leads to another paradox. Sometimes instability in the world actually strengthens the dollar, even when the United States itself is involved in that instability. But there are limits. A lost war by itself might not collapse the dollar, but a lost war combined with financial instability could be different. Imagine a scenario where a major conflict severely damages American credibility. Markets begin to doubt the sustainability of U.S. debt. Interest rates surge. Foreign governments reduce their purchases of Treasury bonds. At the same time, rival financial systems gain traction. China expands the international role of the yuan. Regional trade blocs settle energy transactions and alternative currencies. New payment systems bypass Western banking networks. Each of these developments alone might seem manageable. Together, they could slowly erode the dominance of the dollar. Currency systems rarely collapse overnight. They decay gradually. Confidence fades. Usage declines. Alternatives grow stronger. This process took decades for the British pound. It could take decades again for the dollar. But if there is one lesson history offers, it is this. Reserve currencies do not last forever. They last as long as the system supporting them continues to function. Military power helps protect that system. Economic strength reinforces it. But neither guarantees permanence, because ultimately the global financial system runs on belief. The belief that the numbers written on government bonds will be honored. The belief that institutions will remain stable. The belief that tomorrow will resemble today. The dollar is not merely paper, it is a promise. And like all promises, its value depends on whether people continue to trust it. So if the United States lost a war, would the dollar collapse? Probably not immediately. Currencies rarely fall that quickly. But wars have a way of revealing hidden weaknesses. They expose debt, they strain alliances, they test institutions. One wrong move and confidence could vanish overnight. The consequences would reach far beyond Washington, because the dollar is not just America's currency. It is the foundation of the modern financial system. And if that foundation ever begins to crack, the entire structure of global finance could shift with it. History has shown us this before. Empires do not collapse when they lose a battle. They collapse when the systems supporting them stop working. And the most powerful system of all is the one built on trust. History hides the answers. I show you where to look.